Well, most people treat tax like a mid-year scramble, but those getting ahead are playing a completely different game. Recently, the ATO estimated Aussies claimed over $28 billion in work-related expenses. It's about $2,700 a person. But experts say plenty more still goes unclaimed. So what can you claim on your tax return that you may not know about? Financial advisor Ben Nash from Pivot Wealth is with us. Ben, good to see you again. When should you start thinking about tax?
Look, I think as soon as you start earning an income is the right time to be thinking about tax. At the end of the day, every dollar of tax that you save is an extra dollar that you can use to build your savings, your investments, pay down debt, or get ahead. And so obviously the higher you earn, the more tax you end up paying and the more potentially valuable deductions can be. But I think learning those skills and building your muscle around tax saving and tax strategy, there's no time like the present.
Okay, so, and it's ongoing, 7 days a week, all year, not just at the end of financial year. So what are some of the strategies and deductions people tend to forget about?
Well, the three biggest areas for deductions are motor vehicle expenses is a big one. You can claim deductions of a bit over $4,000 a year without even keeping a logbook, and even more if you do follow the logbook method. So that can be quite significant. Importantly, though, you're not allowed to claim things like driving to and from your office. It has to be travel for work-related purposes, but there's some really significant deductions on offer there. And then if you use a logbook method, you can also deduct some of your car costs and any borrowing costs for automobiles. Also work from home expenses. With more and more people working from home, you're able to deduct a portion of the expenses for operating your home and your home office as well. And then the other big one that we see is education and advice fees. There's a lot of things that a lot of data points that are showing that Aussies are spending more and more on self-education expenses. And a lot of those can relate to your work and help you to increase your income over time, which under the ATO's rules means that they are essentially deductible. So again, there can be some big savings there.
Topping up your super always gets mentioned. Is that a good way of reducing your tax?
It's a great way to reduce your tax because every individual taxpayer in Australia is able to contribute up to $30,000 under the current rules, and that is increasing to $32,500 from the 1st of July. And you get a full tax deduction for that money against your salaried income. Now, that does include any money that's put in by your employer through the superannuation guarantee, the compulsory contributions. But for most people, that leaves a significant amount of room to get money into your super fund. And the other benefit from a tax perspective is once the money's inside your super fund, it's then able to grow at a reduced tax rate because inside superannuation, the maximum tax rate is 15%, which is much, much lower than most people's marginal tax rate. So when you're investing inside your super fund, it builds up faster. Now, if you're a first home buyer and you're looking to get onto the property ladder, it may not be the first thing that you go really hard at because you can't access your super until you're getting closer to or in that retirement age. But there are some really significant tax deductions on offer.
And also, if you haven't contributed up to your maximum in previous years, it accumulates, doesn't it? You can catch up, which is a great tip.
Yeah, so you can, if your super balance is below $500,000, you can catch up on up to 5 years of your previous unused contributions, which again, for most people, you're talking about some significant deductions, and that can be particularly helpful if you do have a capital gain event or things like selling a property. You can use that to get that tax bill right down and drive some more savings.
So what action should people be taking right now in terms of their tax?
Well, I think understanding your deductions so you know what you can claim and what you can't. Second part of that is that you've got to keep good records so that you can back up your claims and also to make it easier for you at tax time. And then look at the tax saving strategies or the levers that you can use to actually get ahead. You mentioned super contributions is one of those. Also things around your investing, your investment structuring, making sure that you're on the front foot with your tax planning around that. And importantly, that you're doing it before the financial year is finished, because a lot of people start thinking about this stuff in July, trying to get a bigger tax refund, but by then it can be too late to do anything that makes a really meaningful difference. So July is a great time to tax plan, but that's for the tax year that we're currently in, the tax year ahead, and then tighten everything up around March, April before the end of the financial year so that you can put some moves in place to actually make a difference to your tax.
Ben Nash, always full of great advice. Thanks, mate. Good to see you.
No worries.